Welcome to the Pro Ticker Deep Dive.
Today, our mission is a critical one. We are diving deep into volatility regime shifts.
Right. We want to know when financial markets flip from tranquil to, well, terrifying, and how that flip gets accelerated by the very architecture of modern finance.
Exactly. We've been looking at research that charts historical volatility, that dissects these vol-selling strategies.
And it also analyzes how systematic funds, the quiet, massive players like risk parity and CTAs, can actually amplify these market swings.
Our goal is to give you a shortcut, really, to understanding these financial feedback loops that can turn what should be a market tremor into a full-blown systemic shock.
And to do that, we have to talk about the two key barometers, the definitive fear gauges.
That's right. First, you have the VIX, the CBOE Volatility Index. It's basically the equity market's alarm clock.
It measures the implied 30-day volatility of the S&P 500 through option prices. So it's telling us about perceived stock market risk.
Then you have its counterpart, the VE Index, the Merrill Option Volatility Estimate.
And MOVE is the bond market's equivalent. It tracks implied volatility in U.S. Treasury yields, which reflects these deeper, more structural uncertainties around interest rates and macroeconomic liquidity.
And the core insight from all the research is that volatility clusters. It isn't spread evenly. It shifts in these discrete regimes.
So understanding the interplay between VIX and MOVE, especially when they start to diverge, that's where you find the clues.
That's where you find the clues. The clues about cross-asset risk that the equity market often fails to price in until it's too late.
Okay, let's unpack this history of extremes. Let's start with that long decade of, I guess you could call it calm, that followed the global financial crisis.
The 2010s, yeah. That whole decade was just defined by extraordinary monetary easing. And this environment, it fostered generally subdued volatility.
So the VIX was pretty low.
Very low. It averaged in the low to mid-teens. That became the new normal. And it led investors to become, really complacent. In 2017, we even saw the VIX dip to near record lows, somewhere around 9 or 10.
It sounds like a lovely, peaceful environment for making money, but the research always suggests that this kind of low vol period is actually inherently dangerous.
It was. It created what analysts call the volatility paradox.
Tranquil markets that are secretly harboring these immense hidden fragilities.
Exactly. And that manufactured calm was just decisively broken in 2020.
Yeah, that COVID-19 crash was an instantaneous systemic flip.
Oh, absolutely. It was an abrupt regime shift where liquidity just evaporated globally. The VIX spiked to an intraday high of around 82.7 in March 2020.
Which was just slightly higher than its 2008 peak.
Slightly higher, yes.
Yeah.
And importantly, the MOVE index also surged. It went above 150.
And the crucial point here is that correlation shift. The classic stock bond diversification just failed completely.
It did. These two major fear gauges, which often offset each other, they spiked in unison. It confirmed that this was a synchronized systemic shock.
And then just 2 years later, in 2022, the volatility narrative flips again.
It does. But this time, the driver wasn't a global health crisis. It was surging inflation and, the rapid rate hikes from the Federal Reserve. This was a classic bond-led regime shift.
And this is where MOVE really took center stage. Bond volatility just eclipsed equity volatility for most of that year, which historically is a pretty rare event.
It's very rare. The MOVE index was extraordinarily elevated, sitting in that 130 to 150 range for months, which is far above its long-term average, which is closer to 90. Meanwhile, the VIX was, elevated compared to the 2010s, but it was mostly just grinding away in the 20s and 30s.
So it was a painful grinding bar market, but not a full-blown equity panic.
Exactly.
But the consequence of this regime was staggering. The classic 60-40 portfolio, it suffered a negative 17.5% calendar year loss.
Which is its worst performance since 1937.
1937.
To put that in perspective, it means the one strategy designed to be a stabilizing force failed worse than in almost any year since the Great Depression.
Because both stocks and treasuries fell together, there was truly no place to hide.
No refuge at all.
So if the bond market is often this insightful, showing stress through MOVE before the VIX catches on, can we actually treat MOVE as a reliable leading indicator?
I think we can, and we should. Bond investors are just far more sensitive to liquidity issues and policy errors than stock investors are.
So it's a natural early warning system.
It is. Take early 2023. In February, the MOVE index spiked over 24% in just a few weeks, all driven by bank liquidity concerns. The VIX, it barely flinched.
That divergence was remarkable. The bond market was effectively screaming about rising systemic risks.
Screaming. And yet the stock market seemed totally content.
And that divergence perfectly presaged the regional banking crisis with the SVB collapse in March.
Exactly. Only then did the VIX finally spike. It confirms the principle. MOVE reacts directly to the cost of funding and rate uncertainty, often flashing red months before equity markets fully price in that macro risk. So for you as a listener, that MZ chart is a vital dashboard indicator.
That context is powerful. Okay, let's pivot from history and look at the mechanics here. Specifically, how this appearance of stability is so often manufactured, and how those same suppressors can turn into explosive amplifiers.
Which brings us to the risks of volatility selling.
Exactly.
During those low-vol periods of the 2010s, selling volatility became this enormously popular and, for a time, profitable trade.
You're harvesting the volatility risk premium.
Right. You're betting that implied volatility, what the VIX measures, is consistently higher than what realized volatility actually turns out to be. And for a while, it was a highly effective high-yield strategy.
But this harvesting relies completely on market calm. And when that calm breaks, you see the structural flaws, which is what we saw so brutally during Volmageddon in February 2018.
Oh, that event. It marked the peak of these explicit short VIX ETPs, like 14.3. These products had earned steady profits, but their design, it had this critical weakness.
The mandate.
The mandate. Their structure required them to buy VIX futures when volatility spiked to cover their short positions.
So a modest equity market drop triggers this forced mechanical short covering wave by these huge products. They were forced buyers of VIX futures.
Which just amplified the initial move and caused the VIX index itself to explode over 100% intraday. It was a textbook systemic feedback loop.
And it was confirmed when several of those inverse VIX products were just catastrophically liquidated.
What began as a mild risk-off day was turned into a violent spike by the mechanics of the vol sellers themselves.
Now, those retail ETPs largely disappeared after that, but vol selling definitely didn't, did it?
No, not at all. It just went institutional. Now it's done with tools like variance swaps and index options. The asymmetrical risk, though, it remains the same.
Right. Picking up pennies in front of a steamroller.
That's the classic analogy, and it's perfect. Institutional players are still collecting small premiums, but they're always facing that risk of an occasional catastrophic drawdown.
But the research points to an even bigger and I think less obvious source of this volatility suppression. It's coming from yield-enhancing structured products.
Specifically, things like auto-callable notes. They're popular globally.
Right, and this is where the architecture of modern banking plays a huge role.
It does. These notes are essentially bonds that embed options, often selling volatility to the end client to get higher yield. And the banks that issue them, they have to manage that risk. It's called dynamic delta hedging.
Okay, can you just boil that down for us?
Yeah.
Why does that bank activity influence the VIX?
Sure. Think of it this way. The bank is short an option to their client. So to neutralize its risk, the bank has to constantly trade the underlying asset. And the key is that this trading is contrarian. Meaning when the market falls, the option risk for the bank increases. So they have to buy the underlying index to hedge. When the market rises, their risk decreases, and they sell the index to rebalance.
Ah, so in normal trending markets, this hedging activity creates a continuous contrarian flow. They're buying the dips and selling the rallies.
Precisely. It smooths out price action. And this contrarian flow, it effectively dampens realized equity volatility and suppresses the inputs for the VIX. The BIS, the Bank for International Settlements, noted this.
They did. They said the meteoric rise of these products coincided directly with a big drop in the VIX between 2022 and 2023.
So the volatility paradox is thriving because these mechanics create an illusory calm.
But the more that volatility is suppressed by this hedging, the more concentrated and disorderly the inevitable correction will be.
That's the core takeaway. Volatility selling creates this huge latent risk. And when a critical threshold is hit, a large, sudden drop, the bank's hedging can actually reverse, amplifying the volatility spike as they're forced to adjust rapidly in a falling market.
Okay, so we've established how stability is artificially manufactured. Now let's look at the huge systematic players that turn a market tremor into a massive feedback loop.
Right.
Let's talk about the amplification effect.
Right. The first group here is risk parity and volatility targeting funds. These are massive multi-asset strategies that allocate capital based on risk contribution.
And they often target a fixed portfolio volatility level, like say 8% or 10% annual volatility.
Yes, and the crucial element here is the mandate. If realized market volatility rises above that fund's target, their models are mechanically, automatically mandated to decrease exposure, to deleverage.
Which is inherently pro-cyclical selling.
Absolutely. In a sharp sell-off, when volatility spikes, these funds become forced, massive sellers by their own rules,
Yeah.
and they add severe pressure to an already declining market.
This sounds very familiar. It's like the modern version of the portfolio insurance that made the 1987 crash so much worse.
It is the modern iteration of that exact problem. And the size of these funds means this forced selling can be immense and instantaneous.
So in March 2020, as volatility just soared, these funds had to rapidly deleverage.
They did. And they suffered outsized losses. And they almost certainly magnified the speed of the sell-off in both stocks and, even in the treasury market, where liquidity just vanished.
Okay, let's look at the second systematic amplifier, CTA trend followers. CTA stands for Commodity Trading Advisors.
And their design is pure momentum. They trade across global futures equities, bonds, currencies, commodities. When a major regime shift begins, like prices start falling steadily, CTAs flip to short positions.
And crucially, their models mandate them to increase those shorts as the trend strengthens. They are trend accelerators.
By design, yes.
And we saw this play out perfectly in 2022. While risk parity got crushed, CTAs had a fantastic year.
They had a banner year. The SG Trend Index, which is a good proxy for CTA performance, was up an estimated 27% in 2022.
Because they just rode those strong trends.
They shorted bonds during that historic sell-off. They took short equity positions, and their sheer trading volume reinforced those moves every step of the way.
Okay, so let's synthesize this lethal interplay here, this architecture of the feedback loop. We have three forces working in concert.
You do. You have the vol sellers, the structured products, the hedge funds keeping things artificially calm, breeding that complacency until a breaking point is reached.
Then, once realized vol spikes, the vol targeters, the risk parity funds, are forced to kick in, selling risky assets because their volatility targets are breached.
And right behind them, the CTAs jump on that new downward momentum, expanding their short bets, which adds even more selling pressure and accelerates the trend.
So the most dangerous scenario is that simultaneous correlated action.
That's it. The vol sellers are forced to buy volatility futures to cover their shorts, while the vol targeters are dumping assets, which creates the very turbulence that boosts volatility even higher.
It's the non-discretionary mandated action of all these groups that turns a moderate shock into a violent regime shift.
And that's what blows out both the VIX and the move in unison.
That structural risk profile is it's essential for any investor to understand. Let's bring this all back to the listener now. What are the practical takeaways?
I think the primary one is the need for dual vigilance. You absolutely have to monitor both VIX and MOVI.
Because relying on the VIX alone can give you a false sense of security. The 2023 example showed that perfectly, with MOVI leading the VIX by weeks.
Right. It was signaling that brewing macro and liquidity distress long before the equity market woke up. So sustained moves in the MOVI index should be treated as a major signal to scrutinize your equity exposure or, maybe add some hedges.
And for anyone tempted by that short vol trade?
I would just say beware of crowding. The lesson of 2018 and 2020 is devastatingly clear. A year's worth of profit can be wiped out in a single day.
So if you pursue those strategies, you have to use structures that limit your losses.
Yes, like selling defined risk spreads and sizing positions modestly to avoid ever being a forced seller yourself.
And finally, that point about regime adaptability. Risk parity was great in the low vol negative correlation era, but it got crushed in 2022's high vol positive correlation world.
Exactly. When VIX or MOVE signal a new regime is forming, you have to recognize that the strategies that worked flawlessly in the past might suddenly become incredibly dangerous.
And from a policy perspective,
Well, regulators are worried. They know that extended low volatility breeds complacency and hidden leverage. Stress testing has to explicitly model a sudden, violent volatility spike to see how this correlated deleveraging would play out.
so if we were to distill all this knowledge, the history, the suppressors, the amplifiers down into one single actionable mindset, what would it be?
It would be to incorporate a dynamic, regime-based mindset. Use VIX and MOVE as your dashboard.
So when they both break above certain thresholds, say VIX consistently over 25, MOVI over 120, that's a signal.
That is a clear signal to aggressively reduce your risky asset exposure or to add hedges, like long volatility instruments.
This is all essential because, as the old adage goes, and it's probably the most important thing to remember from this deep dive, never mistake a low volatility period for a low risk period.
Market stability can be manufactured. It can be enforced by these systematic strategies, But the underlying risk, it never disappears. It just concentrates, waiting until the next explosive regime shift is triggered by the very players who were designed to profit from the calm.
See you all in the next Pro Ticker Deep Dive.